Good day, everyone. We've got a market that looks like it wants to go higher. We've seen like the S&P anyway and the Dow both are nicking, getting very close to old highs here. And basically, the question is, are we going to just shoot out at the starting gate and potentially have a nice uptrend on our hands? The problem, I think, is that the QE spigot is a big part of that was due to the Fed, which started QE in late 2008, and you can see that the uptrends, while they weren't easy to play at all, were nevertheless uptrends of sorts, and we had a more or less a firm bull market between early 2009 and the middle of, or I'd say late 2014, really. And by no coincidence, late 2014 was when the Fed turned off QE in total. So after that, we had a nasty correction in late, well, I think that was October 2014, and then since then, the market really hasn't gone anywhere. It's just been struggling to try to get new highs, and as I said earlier, in broken-leg fashion, it's trying to make new highs, and maybe we're going to see continuation of that, where we have this kind of sideways move that doesn't really get us anywhere. The other central banks are, of course, continuing to ease their policies, but taken as an aggregate, it doesn't seem like they're really contributing nearly as much as the Fed was able to in terms of the QE spigot. So as long as the Fed remains in this hawkish position, I don't think that there's going to be a danger of the Fed moving toward, say, easing or going toward negative rates or any of that. Of course, anything can change in the future, and Yellen herself has left the door open both ways in terms of not hiking rates as long as the global economy remains in a quagmire, and also the potential for hiking rates should things start to clear up. It's doubtful, based on history, that based on what all these central banks are doing, that things are going to clear up and it's going to be just blue sky again. There's a big price to pay for all this money that has been printed over the years. It doesn't just go away. The problem doesn't just go away. So thus the analogy of kicking the can, except the can is now full of dynamite, or let's call it nuclear TNT. And I think it's gonna, at some point, there's gonna be a massive day of reckoning, or call it some sort of massive payback. We saw in 2008 what happened when you create these artificial bubbles created by the government, of course, government's policies. And then this time we have another bubble of sorts. It's the sovereign debt bubble. Again, created by central banks. So. Like I said at the beginning of this year, I expect heightened levels of volatility. That goes great for the VIX model. In fact, as I mentioned, in 2015, where the market didn't go anywhere, it was patient with a broken leg. The market, the VIX model, when I was testing it, did very well in 2015. It somehow it can detect and stay on a signal, even if the market's going sideways. XIV, instruments like that, you see had a nice appreciation, which the model is able to partake in. So even if we get that situation, I'm more optimistic that the VIX will still be able to do well. I think the ideal sweet spot, though, is definitely years like 2008 or 2000 to 2002. 2011 was a great year because there was a lot of volatility, like wide-banding volatility, and the model loves those kinds of markets. So at any rate, we're just going to, stay the course. I think there's more and more opportunity. Potentially, this market looks like it's going to go higher, but again, it could. These trends tend to be very short-lived, and that allows us to spot some great short sale setups as they come through. And Gil, of course, I think we'll talk more about that later in today's webinar. And in the meantime, you got to remain fluid, because we've got some longs that we put on the list, and should the market continue higher, these longs hopefully will outperform. And with that, I will turn it over to Gil.
Well, it wasn't that much later in the webinar. Let's see.
Later is
Here's how I look at the market. You had the last week. You had the undercut of the lows on the Nasdaq. You can see that, and you call this. I guess this would have been Tuesday. You can call that a fourth day follow through. I think. Am I understanding the rule correctly here, Dr. K? You undercut if you undercut the low of this day here. That means that you start counting again here. Is that right?
you would count actually not on that because that day was down. That low day was
Yeah,
down.
but you're
so
coming up. You're coming up off the lows and closing mid-range, so or above mid-range. So it's sort of a rally attempt off the lows.
It's a great, and I don't care what the O'Neill people say. I've always,
Neither do I.
Are always about something. There has to have some inherent logic in the rule, and so you're very correct that it does close. It's mid-bar, but it shows that's a sign of support. Based on that action, it undercuts and it goes to mid-bar. So I think the O'Neill people start counting on the second day, from what I remember. But in this case, your first day is really that first down day.
Well, in that case, you wouldn't count this then as the first rally attempt day down here.
That would be the first rally attempt because it closes higher.
Right. So I guess that would be the holy grail right there, huh?
In this case, because it got support and it closes mid-bar, I would say that could be your first day that you would start counting. So then the fourth day was the follow-through day.
Okay, you see how confusing that gets? From my standpoint, I look at the market on the basis of what I'm seeing in individual stocks, and you guys all know that, those of you who've been around for a while. And I try not to pay too much attention to the indexes, although I do watch, if you get an undercut or you're hanging along support, I do watch to see if at the time I'm seeing an undercut here, I might see certain stocks pulling into logical areas of support where they're offering a low-risk entry point, and then go long on that basis and be willing to try out the trades. And that worked with a few names over the past few days. And so, that's more or less how I operate. At the same time, I have short sale targets in mind, but I keep very tight stops, and if they keep rallying on me, I don't sit there. I just blow them out very quickly. So I think for the most part, you have to be fluid and somewhat bifurcated. So to me, okay, you get some setups, you see some setups popping through, and the indexes, the S&P and the Nasdaq, go through the 50-day moving average on higher volume. So they did that 3 days ago. That's all I need to see to begin emphasizing the long side of the market, as opposed to trying to beat my head against the wall and going heavy short, looking for a break to the downside through support. I mean, a lot of people can say, oh, this looks like a head and shoulders on the index, but we talked about this many times. If they want to get tricky, here's a head and shoulders. Oh my God. And I saw some guy tweeting about how these patterns are so powerful, blah, blah, blah. I don't know. I'm always skeptical of hypey sort of statements like that. The head and shoulders patterns in indexes generally aren't that reliable. I'd mainly stick to looking at them on individual stocks and narrow ETFs like, say, a GLD or an SLV or a USO, but not index-related type stuff. So, if you're sitting there waiting for this to break because you're sure this is a powerful pattern that's going to show a tremendous breakdown, well, you're going to get whipped out. And if you're paying attention to individual stocks and you don't have a bias either way, in other words, you're willing to try any trade that you see set up as long as you know you have a quick out point, in other words, a tight stop, then you take the shot, and that's what I'll do. So and I'll give you an example. Here's one. I've sold this one into the move, though, because it jacked. But, if I see a name like this, when we put this out, come on up. We put this one out here when it had this pocket pivot. And at that time, it was trading about, 500,000 shares. And it's a little thin Chinese name, so you get a pocket pivot here, but it worked really well, and the stock went higher. Now it's going tight sideways. You notice the average daily volume has been increasing, and now you're over 1 million shares. So it's starting to grow up a little bit, but what I notice here is on this day right there, that would have been 4 days ago, you get this little doji if you're looking at a candlestick, but you can also see what I'm talking about right here on this typical bar chart. So you're getting a little doji, so it's very tight along the 10-day line, and the volume's drying up. I think that was minus 45% below average. So that's a setup, and I see it at that time. You notice how it's fairly loose in here, and then finally it tightens up right in here. So I'll take a shot, and bingo, it works. You know, imagine that. And I'll operate on that basis. I'm not really watching to see whether the market is going to sell off or not. Maybe it is, maybe it isn't, but I figure at the very least what will happen is I'll just get quickly stopped out of my position. I'll just blow it out. It's pretty simple. If you look at you know, Salesforce, another one I've been playing, you had the Bible gap up here. The market bottomed a couple days later, but at the same time it's holding tight, and on the basis of the Bible gap up and the fact that, you know, right here your low is 80.71 and the low here is 80.15, that's pretty tight risk. I mean, if it blows back below the low of that 80.15 low, the low of the BGU day, then I'm gone. And so I can play these trades on that basis without having to get bogged down in what the indexes are doing. I talk about this all the time, but for those of you who are newer, I would emphasize that, and it keeps you out of trouble. And worrying about whether there's a follow-through day or there isn't a follow-through day, or you have a green light or a red light. You know, I like to joke about, some of you might remember, if you're my age or older, Engineer Bill was a kid's TV show, and he used to have this red light, green light thing with a glass of milk, which now we've all learned we're lactose intolerant, but back then everybody drank milk, and you wondered why you had digestive problems. But Engineer Bill was part of the milk industry conspiracy to get everybody to drink more milk, because you'd get, you know, be green light, drink your milk, red light, stop drinking your milk, and people want to rely on simplistic things like that when they're investing. But I think you can just go by what the stocks say. So, you know, I've said my piece on that. So what is there in a viable position? Well, you know, I'm looking at Tesla this morning, and it had, you can see in here, you get a few, these are 3 pocket pivot, 5-day pocket pivot volume signatures. 2 of them occur at the 10-day line, one here and one here. And then the third one occurs on the move here. Now they came out and priced their secondary offering, I think, at 215. So, you know, right immediately stock rallied up there. I think that was this day here, 5 days ago on the chart. And now the stock's trying to poke above the 200-day moving average. And volume maybe, let's take a look here. Oops. I'm going to update this very quickly. What's volume running at right now on Tesla.uk? I want to check my projections on my HTSI.
It's at 14%.
Above average? So,
Yeah.
okay, so if it traded that, it would be above the moving average line here, assuming it held that. So that would put it on track for a pocket pivot coming up through the 200-day line. And of course, everybody hates Tesla, and we talked about it as a short, and it worked briefly here, breaking below the 200-day line, but it undercuts this low here and turns around and heads back to the upside. The whole world's short the stock. So, you know, I can take a shot here using the 20-day line at 220.24 or just the 200-day line if I want to keep things really tight, but that's probably a little bit too tight for a stock like Tesla, since it can swing around 2, 3, 4 points relatively easily. So I think in that case, you might use a 20-day line, or you could give it down to the 10-day at 214.38, which is really only about 3% away. So, you know, that's something to look at, and that could turn and go higher, mainly because everybody hates the stock. Everybody's convinced that it's going lower, and over the long term, it may eventually catch up to reality, or reality may catch up to the stock, and it may end up being a $45 stock, as many leaders often, you know, end up in the junk pile eventually. But in the near term, it may be good for a trade, maybe as far as the 50-day line, maybe back to the highs that we saw back in April. That's not out of the question. So I think, you know, you got a trade here, you can try it. On the short side, if I see a trade like this, Carnival Cruise Lines, I've been thinking these cruise lines are kind of goofy and probably in trouble. I know I've heard from some people they have great experiences on cruise lines, but I also know people who've had really bad experiences, namely people who got caught on that one was it a Carnival cruise or Royal Caribbean where they were stuck out in the water and the engines had all died. That was exciting. That would definitely ruin your vacation. But you can see here, you get a reversal here on a gap down move, and as soon as it's below the 200-day line, I can come after it on the short side and use the 200-day line as a quick upside stop. Now, I don't know that it's necessarily going to work, okay, but at least I have a reference point for a trade, and since I've been thinking this stock, and we've talked about this, the overall pattern is failure prone because it's a V-shaped cup and sort of a wide and loose handle it's trying to form, and it's failing. It's really kind of a late stage base failure formation. Then I'll go after it on that basis, solely on the basis of the setup, without worrying about whether the market's in an uptrend or a downtrend, because in this market it seems to be the case that you're getting setups on both sides of the market. Sometimes there are more long setups, sometimes there are more short setups. And I think you just wait for the right spot and then you pick them off. And I'm not even sure you're in a swing trading environment as much as you might be in a day trading environment where you're taking much quicker profits. Another one would be Disney. It's popping up here up against the 50-day line. Some of the consumer names seem weaker. McDonald's has been another one. But again, this one, I'd like to see it rally up further to short it, but it's just in a bear flag. Maybe it's just going to roll to the 200-day line. But if you look at Disney, it's hanging underneath the 50-day line, and it is, here's the overall pattern. It's sort of a two-headed head and shoulders, or you could call this like a pod-like late-stage failed base. It rallies up to the 200-day line and fails. We talked about this one, and I think you can short it here if you want to have a short or two in your back pocket. And I have nothing against being long a couple of things and being short a couple of things. Maybe I might be long 3 things and short 1. And then I'll flip if the market starts to come in. That was one technique I used quite a bit in 2014. I was up triple digits. Last year I didn't trade as much, but I had my moments, and that was a similar sort of situation. But I think in general it's possible to operate on a bifurcated basis and just let the setups take you in the direction that the setups want to let you. But you have to get past all of this trying to think in trend following terms. In other words, follow through days or no follow through days, distribution, whatever. It doesn't matter to me. I'm more interested in the setups. I think one of the best long setups we've had recently. What's that, Dr. K?
I just want to point out that 2014 from October and 2015. I mean, these follow through days and blah blah blah. Obviously, don't mean anything when you don't have a trading market. So, and I think, even prior to those years, we've always reinforced the notion that it's about the stocks. I mean, I remember back in the days of O'Neill when people said, is the market going higher or lower? I said, I don't care. All I care about is what my stocks tell me to do. Do they tell me to sell them or buy them? And that's always been my beacon. It's always worked. It still works today. And I think that's the strongest indicator one can get in terms of market direction. Now, in a year like 2015, you have a lot of stocks that do line up and start to look like they're about to break down, but then QE comes to the rescue. So then, timing the market is very challenging in that situation. And likewise, you get setups where all these pocket pivots come through, but then the uptrend is muted because there's a lot of loss of confidence out there. So it certainly has not been an easy market, and I think some media accounts said last year was the most challenging year in 78 years. But this year is a different I think different dynamic that we're getting, which is good because markets don't really like to repeat themselves. So anyway, go ahead.
Yeah, and so it's a matter of watching the stocks. I like this NVIDIA, which we put out a couple of times, but after earnings they had a gap up move, and it's a viable gap up, and we have specific parameters for buying it. So at the time I think it was trading around 40, and the low of the day was 39. So you're pretty close, 2.5% to that low. You just take a position in there, and I think during the day it kind of pulled in fluttered about, and then it's gone straight higher about 10%. So do you take your profits here? Maybe you do. And see if it comes back in. The 10-day line is way up there, but I would anticipate it's either going to go tight sideways or you see a pullback. If it occurs soon, it may go down to the 20-day because the 10-day is a little bit too close. But here's one that works, you know. Here's another one to look at possibly is Home Depot. This is kind of a funky double bottom, I don't know what you call this, a V-shaped, narrow double bottom, cup with handle, weird thing, pod, baby pod, whatever. And it's failed on the breakout. Notice you had no volume on the move to all-time, I think it was all-time highs, I forget. But you got, right here you have a very, very light volume, below average. And you get a rally back up into the 20-day, 10-day confluence here. And it rolls over. Now it's rolling back up towards the 50-day line. So it's coming into shortable position. So, you know, I would take, actually I'm putting this one out here. And I'll put them out there, okay? I don't, if I get stopped out, I get stopped out. I can use yesterday's high, which is I think at 134.40 or something like that, and just play the trade and go operate on that basis without worrying about, you know, what the trend is. Because if we roll over, we could roll over hard. And it often helps to have some short positions in play or working for you, or at least have some targets ready to go after. Apple's interesting because I think this is a classic shakeout type maneuver, and it's an undercut and rally, which is my way of categorizing Livermore's shakeout plus X or 3, whatever you want to call it, and also Wyckoff's concept of a spring, which is basically undercutting a prior low, which fakes everybody out and sends the stock on the upside. And this pretty much set up a rally. If you're trying to short this, the 10-day line was your stop, you would have been out. If you try to short it again at the 20-day line, you never really got a chance because it gapped above and has continued higher. Now you're approaching the 10-week line on the weekly chart and the 50-day line, which is not really that far away, about 3%. So this could be approaching a spot where it could be shortable. I think the news that Warren Buffett's fund, or Berkshire Hathaway, his holding company, is bought 9.5 million shares of Apple, to me is kind of irrelevant. But on the basis of the technical setup, you can see how the news kind of jives with what was going on technically with the stock, which is kind of interesting because a lot of times the technicals will be showing you something and then there will be some news event that causes it to play out the way the technicals were already showing. So in this case you have this undercut, which is a fake out. It's White Coffee and Spring, Livermore shakeout plus whatever. Probably, in my view, I wouldn't use a shakeout plus a 3. I would use just the undercut and the move back up through the 10-day line, and you could go long and use the 10-day line as a stop and then play it out. Now that you're coming up to this shortable gap up move or gap down move here in late April, and now you've run up past that. So I don't know if you roll over in here or you roll over closer to the 50-day or you keep going higher. I really don't know for sure, but I'll test the position out based on where it is within its pattern. So another one to look at in this regard is Netflix, which is right at the 200-day line. Maybe this becomes shortable here. Who's that guy on CNBC, the bald, loud guy, Kramer, yeah. He is babbling on his show last night that Apple's looking to buy a media company, and of course that always brings Netflix into play. This could turn out to bring the stock into shortable range. So unless you believe that there's an announcement that Apple will be buying Netflix imminently, this could be shortable near the 200-day line. That's a possibility. So if there was some announcement that Apple was buying someone else, another media company, that could be Hulu or well, it can't be Amazon Prime, but any other media company, Time Warner, there's been talk of that. So if there's another buyout or a buyout of another company, then you might expect to see this just plummet. So you know, I'm a little skeptical that they're going to buy Netflix, but it's got the stock going, but it was already turning to the upside. And you can see here you do get an undercut at the 88 level, and that sets up a spring back to the upside. So, and you could see these all occurring as the market was trying to bottom. You know, Netflix is around the 20-day 5 days ago when the market was along its lows back here. So back around 4,700 on the NASDAQ, for example. And it was turning beforehand. And you can see that turning, and so you can try shorting it at the 50-day, but you'd be stopped out very quickly. Now you're up to the 200-day. So if you're testing the short side into a rally, you definitely want to maintain tight stops, and don't get carried away with having to force things in that regard. So, any questions so far? Nothing really. I think one of the things that I thought was interesting over the last couple of days is that you saw pocket pivots. For example, there's a pocket pivot 3 days ago here on Microsoft, and it runs up close to the right up to the 10-week line, where it probably could have been shorted. Usually if I see a pocket pivot, I'll stand aside and let the stock sort of play out. You notice you also come up to these highs over here on the shortable gap down, so that actually brings it into a short sale position if you want to hit it that way, and you could get away with making a buck or so here. Maybe not that much, but it comes down to the 20-day, and now it's kind of bopping around. Where this goes from here, whether it rolls over and fails back to the 200-day line, probably depends on what the general market does. So, but that's the sort of thing that you're watching for in some of these. So you get a pocket pivot on that one. You had a pocket pivot here on Google, if you can see that, occurred 3 days ago, just like it did with right here. Just like it did with Microsoft. So it comes back above the 200-day line, and we've been trying to short it along the 20-day line up here, and that's worked. But now you get below the 200-day line, that's got to be your trailing stop. So as soon as it pops above that, you've got to be out of the way. Now you're coming up to the 50-day line, and here's this gap down move, which could be considered a shortable gap down. It's approaching that, so you're getting within short sale range on this one, and so that's got to be watched as well. Okay, so that could turn into a very nice short sale opportunity under the right circumstances, and probably that would center around the indexes all coming apart and rolling back to the downside, which I don't think you can really discount. So also Biogen was another one I've been watching on the short side. It was looking like it was going to roll over last week, but you can see you had a pocket pivot 3 days ago, and now it's pushing through the 200-day line. So there's no place to short this yet. You'd be standing aside on this thing if you were looking to short it. And I don't know if it's, these things are way down there, so maybe it has more of a rally in it, particularly if the market continues higher. So you definitely don't have a reason to short it here just yet, but it's one to keep an eye on. So, there's a whole bunch of these I've noticed. Broadcom has turned, and 4 days ago it had that was a 5-day pocket pivot, but it's turning back to the 20-day, and it's back up towards the highs. This is what the pattern looks like on the weekly chart. So I don't know if that becomes a big bad buy situation on that basis, but it has run up straight up off the low. So that move is pretty extensive, and it fails on the breakout attempt and drops below the 50-day line. Now it's drifting back up. You haven't had any heavy volume in it, but if this pulls it in the 50-day line, does it become viable? That's something to consider. So, I also noticed Mobileye was another one we talked about on the short side. And see, and this is what I'm talking about. They may show a pocket pivot, so you stand aside, but if they come back and fail, if the pocket pivot fails, which is not uncommon for pocket pivots when stocks are trying to rally and the market fails, or they just fail outright, they don't follow through. But you have 2 days of a pocket pivot here trying to round out a turn off of the lows here, because it found support along these lows and now it's turned. But it rolls over and fails. Boom. You could actually come back on the basis of this breaking the 50-day line. You could short it right there and come back to it. So again, there's a fluid situation. Let's look at Facebook. Facebook is this trying to pocket pivot today finally, Dr. K?
Is Facebook a pocket pivot today?
Yeah, is it on track possibly? It needs to exceed volume here.
It's a very close call because we're 2 hours into the trading.
Yeah, it's still early.
I think it's close call. It has to hit 31 million. And we're only at 9, so.
Yeah, I think we should load up on it. It's probably going at least another $5 higher, right? If the market keeps going higher, it could. I think if it's unable. Go ahead.
Leadership characteristics. It's definitely demonstrated leadership characteristics with the 2 prior gap ups, 3 prior gap ups, and so it corrected its defects, especially with the last earnings report. And it's holding tight, sideways. I think it's primed to certainly outperform the major averages if they go higher.
Yeah, so it's a big stock name, and to me, the fact that it is a big stock name gives you some clue as to where the market's headed. If it acts well and the market continues going higher, then it's obviously going to continue higher. If it breaks the 20-day, which it almost did in here, it got close, but it didn't quite. You didn't really get any heavy selling volume on the test, and it was actually undercutting the what is this 116.23 on the low of this Bible gap up day. So it never closed below that, I don't think. Well, it did on this day, but it just barely undercut it, and you could give it, a little porosity of a couple of percent on that basis. But for the most part, it's held in tight. And if we look at it on a weekly chart, here, you can see it's holding tight. So volume is more or less declining, and it looks like it wants to go higher. But I think it depends on what the market does. If it's holding along the 20-day line or the 10-day line here, it's probably viable, or you could just buy it outright and use the 116.23 low, or this low of 115.97, I think it was, the other day as your stop, or you could use the 50-day line as your stop, because it's within 5% roughly, and for most people that's fine. And I think that generally can work as a reasonable stop without getting too carried away. So I don't see any questions today. Is everybody asleep? I know we're pushing into summertime, and it's becoming vacation time for a lot of people. At least that's what I've heard. But
I just want to say, I think it's interesting that despite the hawkish Fed comments over the last few days, that the markets chose to rally instead. And it's like I don't think they believe the Fed. Well, they're going to believe Yellen, and Yellen's, I guess, the most vocal or the most powerful voice, obviously. And when she said that the Fed won't be hiking rates as long as the global economy remains stuck in the mud. And I think, the global economy, I don't think it's going anywhere. I think it's going to have a lot of problems going forward. And so I think the Fed's hands are tied, and that bodes well for QE in general. So it's entirely possible that, markets tend to know more than we do. So if the market really starts to go into new highs on an uptrend, I think that's telegraphing something to us that the global economy sucks, and that the Fed may force the Fed's hand to reversing the rate hike they did back in December.
yeah, it's possible. Right now, it seems though, if you look at the precious metals, they don't believe the Fed, or rather, they believe the Fed. Bonds don't really know what to believe. The dollar doesn't really know what to believe either, because the minutes came out somewhere in here, and it's kind of chopping around, so it's sort of in no man's land. But the precious metals are coming in, and I'm wondering if that sets up a buying opportunity. So, for example, you got silver holding above, you got the breakout point here, along here, so, in this area, and you're pulling in down to the 59. Does that create a buying opportunity? I really don't know. I think you could take a shot, I suppose, if you really feel that the Fed is not going to do anything. And on that basis, come in and buy it. And if it fails, say silver fails at the top of the base, then you're gone. So I'm not sure what you do with gold, though, because it's already failed. If we look at this, you can see you had a trend line breakout here. So here's a breakout, and it's failed on that. So it's rolled over, and it's violated the 50-day moving average. I mean, this looks like it's going to go lower, but maybe it's just telling you that there's a general move out of this commodity and into oil. What's oil at right now, Dr. K? It's still over 50 bucks?
Yeah, it's still on its uptrend, and there's no sign of it abating that. So
yeah, now is that good for the economy or bad?
Well, it's good in the sense it's renewing hope that there's demand for oil, which kind of then says, well, does that mean that the economies are actually getting better? And yeah, it's a viable argument.
But isn't the decline in oil also a function of supply as well?
Yeah, of course. The supply-demand equation, and there's a lot of forces at work when it comes to the price of oil and the price of gold, as we've said many times. And right now it looks, we're in an uptrend on oil and commodities. The whole Commodity Research Bureau index correlates pretty heavily with the price of oil. and by no coincidence, it found its low in February, just like oil did, and it's been on an uptrend since. And so that is the question of, well, who's exerting the demand on these commodities, or is it that the supply is running lower than expected? I think it's a combination of things. But markets live to surprise. So even though things are not looking good with the economies globally, etc., that maybe we'll start to see reassuring signs that the economies are starting to do better. My opinion doesn't matter. No one's opinion matters. But my gut says, I think that my gut says that how can these economies just all of a sudden repair themselves given what's been going on around the world and with all these central banks? I think we can see a short-term rally like what we're seeing now, but ultimately I think that there is a price to pay for everything that's been, all the money that has been printed over the last several years. It's a steep price. It's not, this market that's been artificially boosted by central banks since 2009. We haven't had a 20% correction. The market, that Holbert piece came out the other day, and I was just I like his stuff. I don't mean to denigrate the guy. I like his pieces, but it did miss the point. I mean, there hasn't been a bear market. We haven't had a correction greater than, I think the greatest correction we've had is like 17% in the last 18 months. So, this last 18 months action is not any way a bear market. It is a major top, but that major top could be nullified should markets get off to the races again, and then we start to hit new highs on an uptrend. Then yeah, then this major top was a fake out. And that could certainly happen given the amount of manipulation that goes on.
Yeah, I think if you look at the market, it still is in a big consolidation. At least with respect to the Nasdaq, I think the S&P looks similar. But you could say that you have been in this big sort of bearish consolidation for a while, and it's really not going anywhere. So, 6 of one, half a dozen of the other. Is the glass half full, half empty? And I think somebody once said that it doesn't matter if the glass is half empty because it's refillable, which I thought was pretty wise statement. So, anyways.
I guess if you can always print whatever you want up to a point until you currencies to really get value.
Somebody asks, hard to find any leadership, any emerging ideas. Not really. I don't see anything. There's just YRD. Whoops. I'm using the Nasdaq. I have to use this particular chart for the Nasdaq because it's configured to show Nasdaq volume. But if you look at something like, here's YRD. Is this an emerging name? Little thin Chinese name is Weibo, which they call the Chinese Twitter. A big hot name. I don't know. It's chopping around. You get some selling volume in here, and these are among some of the, I don't know. Are they really fresher merchandise? I don't know. How about this one, Match.com? Do you like that? Is this an emerging name? It's pulling into the 20-day line. So I know the world is filled with lonely people. And I'm not sure whether it's fortunately or unfortunately not one of them. Sometimes I feel I got too many people around me, but maybe this is one. How about bats? This one was looking great yesterday, and it comes right back in. This is the alternate exchange. I think a lot of these guys allow people to use their quotes, so a lot of these systems, like I think HSI uses BATS data, I think, or some of these real-time systems are able to do that. I don't know. In any case, that's kind of interesting. Let's see. Does anybody know of any other hot new IPOs that are out there, or recent IPOs? I thought Square for a while, whoops, had a shot. Whoops. Here we go. And this looked okay for a little while. This kind of looks like Match at this point right here, and then you have the big break after earnings, and that thing seems dead in the water. ACIA, hot new IPO. Yeah, there's one for you, but it's relatively young, so not really clear to me whether it's in a position yet to play, although you could have picked it off down here. A couple of you mentioned that one. Someone's mentioning, let's look at some other ones.
What I want to say about a stock like ACIA is in normal markets, of which this is not one of. I remember writing a code for Bill that because his relative strength thing was really messed up for stocks that only that traded less than 90 days. And this is the kind of stock in a normal market where you could use the pocket pivot concept to get on board early. So in other words, you would have bought this thing 4 days ago because the volume measured up, and but this is not a normal market. It happens to be working in this market, but I think your risk is very high in trying to use that concept right now.
Yeah, it's I guess I'd have to Acacia Communication. I guess I'd have to look at that one. It looks interesting. But other than that, it's very few things that look interesting. I think let's take a look here real quick. I did it again. Let's see if I have an IPO list. These are some of the more recent IPOs that I have in here, but a lot of these are older names. I don't even know if this is correct. Seems a little bit. Zendesk, here's one. That's not that new. It came out a couple years ago, but this one's trying to come around. And it's kind of pulling back into the 10-day line and holding tight. That looks kind of interesting, but it's part of the whole cloud thing. But I've noticed, you get CRM running among cloud names, which seems to be what my friend Ian Woodward over at HCS Investor would call a wolf pack. And so here you have now, volume is real light here, I think, on this one. It's trading, let's take a look here. I hate when it does that. 49.4% below average on NOW. So that's pulling in here right to the 10-day line. I think that makes it fairly low risk. You did have a pocket pivot in here 4 days ago. So I think it all depends on what the market does from here. So, but that would be one coming into low risk area. Here's Citrix Systems. This one's schizophrenic right now. It doesn't really know what it wants to do. But again, this is another one of these V-shaped things, which makes me a little bit wary of them. But for all we know, we're in a weird environment where this sort of pattern is going to work, because it's a QE market. And normally that sort of thing won't work, but maybe some of these work. And a lot of these, CRM, Workday, they're all these V-shaped things, but they're trying to set up. So, maybe this group will work. I've noticed it's been acting better. Splunk has been able to pop above its 200-day line on a pocket pivot, I believe. And so that's hanging on. I think they're coming out with earnings. What's that, okay?
Mention on CRM, that's a good example. The nice thing about gap-ups is that they go a long way to correcting defects in the pattern. So it's had 2 gap-ups over its last 2 earnings reports. So that more than rectifies the V shape in the pattern.
Yeah, so it's it looks like it wants to go higher. That's another one of these cloud enterprise software type names. Now is one of them. I already mentioned that. Citrix, I was saying, it seems a little schizophrenic. It looked like it was popping on a couple of pocket pivots, on a pocket pivot breakout here, and then it gets slammed on some volume. So now it comes in. You could, if you saw that, what would you do? You see that starting to fail on heavy volume. My instincts would say, okay, back away. But what happens? The thing turns right around today and goes right back up towards yesterday's highs. And volume is pretty good right now for this time of the day. But how do you know this thing just doesn't roll over again? It's a little bit funkier. I don't think it's as strong of a cloud play as some of the other ones. Adobe could be considered a cloud play as well. And you had a breakout here, which is neither a pocket pivot nor a standard issue breakout because the volume is pretty low. But it's acting okay. It comes out and kind of fakes you out, and that's typical for this market. Things will fake you out. They don't have the same kind of volume. I haven't seen very many stocks rallying on heavy volume over the last few days, even as the market's been going higher. And that's a little puzzling. But like I said, if you stick with the setups, you're doing okay. Electronic Arts is hanging tight along the 10-day line after a Bible gap, but this looks okay to me. Volume drying up today along the 10-day. Another one I like is Activision. This is holding the 10-day line, pulled in on light volume. It's viable right at the line. Now it's turning back to the upside. Doesn't care what the market does. And that one looks okay to me. But again, there is this little sort of a big cup with handle. This isn't so bad, though. I mean, it does hold tight along here, and it's not as V-shaped. It takes some time to consolidate the move off the lows. Electronic Arts is in a little better position as well because it's come up against the highs of this big base here. I don't know if you call this a, I guess it actually starts here, so it's sort of a weird looking cup with handle, but I would just buy it on the basis of the viable gap up, and you're holding tight for the last 2-3 weeks. So this actually doesn't look too bad, all things considered. So let's see, I'm going to go through some questions. Someone's asking about some shorts. Someone says, I feel like I see a lot of short candidates like CBS. That's one. Yeah, that looks like a short candidate. EW, that's another one. Yeah, I've seen some of these. PM, Philip Morris, that sort of does, but it's a defensive stock. Coca-Cola, that's a defensive stock. So the argument here could be that you're moving away from defensive names and towards growth names. Who knows? Facebook's still trucking along here. I'm seeing Intraday. Lulu. I think retailers are weak, so that may be in a shortable position. It's all the way back up to these highs in a big ugly cup. I mean, we've seen other names like Under Armour going lower. SKX is another one. I think you had a couple of retailers yesterday came out with earnings, and they're gapping up. I don't know if those are shortable gap ups or viable gap ups. Target has been getting slammed. So the retail area has been weak. That's why I like some of these consumer-oriented shorts. You know, the HD, which is still rallying. It's just kind of hopping. Let's take a look on the 620, see what it looks like. Where are you, 620 chart? Here we go. And it's still hopping along. No real. You are getting a cross here on the MACD, if you guys can see that. So it may be reaching a point where you could start putting out a little bit here and seeing if it rolls over. You keep a stop, you know, 135 would be pretty reasonable, somewhere in there. But you're looking for the market to roll over to help you out. So, but that could happen. So that, you know, there are some short sale setups. So what you're seeing there, Chris, is not. Your eye is correct, in other words, and so you have some shots you could take on the short side, and if it makes you feel comfortable to have a short position or two while you have some long positions, then that's, you know, more power to you. I do that all the time, and sometimes if I'm short a couple of things, maybe I'm hanging on to one long that I think has good prospects. It's psychologically it's psychologically helpful to be able to have that, because it is cushioning you and also putting you in position to snag a short sale profit, and if you cover it and everything turns back to the upside, now your long comes back into play. So I think that is definitely, those are definitely doable in terms of being short. So market's down. You know, I see a lot of things all over the place this morning. I was looking at Yelp. You know, this is like the ugliest of the ugly ducklings. And I actually bought it a couple days here when it was down, and I sold it into this move. Made a few cents, but it's going tight sideways. I don't know if this thing's going to try and turn and go higher. On a weekly chart, this is what it looks like. It's pretty ugly. There's some hedge fund guys said they took a big position, and they're activist investors, and they're planning on getting the company to do something. I don't know what, but in any case, it's holding tight. I also noticed VMware was holding tight. Maybe that's going to pop through the 200-day line. Tesla is moving. It's pushing higher, just a little bit, not much. Fit was another IPO that failed. True. That was but it had a good move. You know, it had this little move here, and then that was it. G-Pro was better, I think. Was another one. Sedge was pretty good. Solar Edge, but that's died. Somebody asked, Ulta reports today after the close. Flash pocket pivots. Any thoughts on taking a position? Well, you got to figure that out for yourself. Personally, I don't see any reason to buy it here, anticipating some sort of major move after earnings. Maybe it does, maybe it doesn't. My preference would be, let's say if I bought it down here and I have a nice cushion, I might hold part of the position. So But I'm not going to tell you, yes, you should hold it here. You know, like I can tell you that. You take your risk, you measure your risk, and you decide what sort of position you want to take. So, DY, nice BGU. Yeah, that was a decent BGU. It's coming out of this position. And you look at this whole area, there's Vulcan Materials, I think there's is it EXP? Eagle Materials, yeah, that's acting pretty well. And Dicom is sort of in that range. They're big construction, which I think is sort of a cousin group to materials stocks, which have all been doing pretty well, like these. So yeah, that's one that could have been played. So they're there. You know, the trades are there. Ollie, I don't know if I like this one. It's a thin little retail name, and retail has had some problems. I know I saw Dollar General the other day trying to pop out. Yeah, see, that looks like a viable gap up here. And it's probably Ollie's probably getting some strength from that too, unless did they announce earnings? But it could be, you know, that looks like it may pan out possibly as a pocket pivot. So something to keep an eye on, you know. What's that, Dr. K? You being visited by aliens?
It's no point in going into any of them.
Let's see, other names, Dollar Tree, yeah, there's another one. So you're getting the whole group. So, you know, I think maybe Dollar General and Dollar Tree are better. They're thicker names. Ollie is possibly playable. And you could look at other ones. 5 is another one. You know, someone's mentioning that one. But that's kind of eh. Priceline, someone's asking about. Looks like a right shoulder rally. Possibly, yeah. See, that looks shortable too. So, yeah, and could be a big head and shoulders, the right side of the right shoulder here. You can see the big break on volume. It's hovering around. Yeah, that looks like a possible short as well. So you could look at that. Good eye on that one, actually. And then Netflix, somebody's mentioning that it looks shortable on the 620. Yeah, it's starting to reverse. So like I said, this could turn into a very juicy short. In fact, you got a 620 sell signal a while ago, probably when we started the webinar here around 103, and now it's heading lower. So, you know, but you'll get a lot of dumb retail money buying these. So I thought it was interesting. And to me, it's sort of indicative of how people really think the wrong way. But some guy arguing with me over transaction costs, and that, you know, good business sense means you don't want to have too high transaction costs. So in other words, you don't want to trade too much because then you're paying too much in commissions. But my experience is that when you're trading at 3 mil, you know, which is basically 3/10 of a penny per share, it's pretty much irrelevant. And trading activity, yeah, generates commissions, but if it's 3 or 2/10 of a penny, it's so irrelevant, it's almost ridiculous to even think about. But I thought it was interesting that this person was trying to make a big argument about why you need to pay attention to this, and I really don't think you need to. And so I was interested, Dr. K, what's your take on transaction costs? Is it something that is a factor in your investment process?
It comes down to the person's account size and how much they pay in commissions. You know, simple.
There you go.
Formula.
And for me, it's not a factor.
Used to charge a lot more money back in the day, and it was more of a factor if you had, you know, a $10,000 trading account and you're getting you know, $50 each trade, and you trade a lot. But you know, these days, you know, everything's so dirt cheap. You know, and they don't really even charge by the share anymore. They used to charge. Remember, they used to charge a few cents for each share traded.
Right.
You know, and these days, you buy as many as you want and you get a flat rate. You know, like Schwab is supposed to be the most expensive of the discount brokers, but I think Schwab's like $9.95, and you can buy. You know,
it's $7.95 a trade, and it doesn't matter the size of a trade. So even if you're buying 100 shares, you're paying 7-8 cents, which is pretty minimal. And if you can't make money trading at those commissions, then I think you should probably just give up trading. But I think it's interesting, though. You do get a lot of different perceptions about transaction costs, and you see that the advertisements on TV, because the brokers are all having trouble, so they're trying to get clients any way they can. But you see that, you know, are you asking enough questions, you know, asking your broker about your fees and making a big deal out of it. But even a 1 or 2 or 3% fee, what does that matter when your objective is to make huge money? So, you know, yeah, if I'm trying to squeeze market returns, index returns, I guess it matters, but for the most part, it doesn't figure into my trading style or even considering what trade I'm going to take. Like I won't say, well, I've already done 4 trades today. I better not do another trade because then my transaction costs are too high. To me, it almost sounds ludicrous. But anyways, just we wanted to get your take on that. Somebody says price, execution, and making money are the only factors. Well said, Jack. That's really all you need to worry about. I mean, Bill used to say, you know, you're worried about saving pennies while you're losing dollars. You know, and he used to slap people around when he heard them say that sort of thing. And you know, that's a common retail investor BS type of thing. Anyways, all right, let's move on here. But you know, the other thing, if you do have like $1,000 account, you probably do have to think about it. But maybe you don't have enough money, or you need to find a cheap broker. So, okay, what else? What else is exciting here? Looking around my wonderful buy watches. Here's Acuity Brands trying to hold up. I don't know. Is this a pocket pivot it had 3 days ago, Dr. K? Did that qualify? Can you tell me? Pulling in on really light volume here, so it might be considered to be in a buyable position. You notice Disney's pulling in a little bit.
Didn't quite make it.
Didn't quite. Okay. Silicon Motion has done okay, but again, yeah, this is the type of name you buy. Here's your voodoo pullback right here, 6 days ago, right on the 10-day line. So, Amazon's holding up. You know, the way we looked at this is that if it breaks the 700 level and confirms okay, because you know. A late-stage failed base, what do you need to see? You need to see a breach of the 20-day moving average, which is a green line here, and it hasn't done that. Now, you could use Livermore's rule, century mark rule in reverse if you wanted to, and try and short it on the breach of the 700 level, but it really wasn't much of a breach, about 1%, I think, if that. Maybe a little more, 1.5%. So, you know, it's pretty minimal and not really relevant as a break because it's still holding above this little consolidation right up here. So this may still be in play as a long if the market goes higher, but you definitely want to watch to see if you get a breach of the 20-day line because this would confirm it as a possible late-stage failed base. So, you know, so there are a few things to buy. There's you know, Maxell or Max Linear. I want to call it Maxell. I think that was the old Maxell symbol. Remember the cassette tape maker? That was a core holding, a long-term core holding for sure. It reminds me of the broker I knew at Merrill Lynch. I don't know if I told the story before to you guys, but when I was a broker at Merrill Lynch, everybody was encouraged when you're a trainee and you're starting out, you're encouraged to have your stock. You know, you got to have a stock that you know the whole story on and you can pitch to people, and you want to build a big position in it and get all your clients in it. So, you know, I remember picking stocks like Marvel Comics, Cisco Systems, Selectron was another one. But this one guy, he picked Smith Corona, and this is in like 1992. Talk about timing. Smith Corona as a stock that that people need to own for the long term. Okay, typewriters, yeah. Anyways, not sure why I went off on that. What else is going on here? Notice, finally, I'm going to close out with this, but the Palo Alto Networks comes out with the earnings tomorrow, I think it is. Today, actually, after the close. So these cyber has rallied. It had a little pocket pivot action here and has moved above the 200-day line. It had a pocket pivot yesterday, I believe. Yeah, it did, to clear the 200-day line, but we'll see what happens with Palo Alto Networks, which is hanging in no man's land just underneath the 50-day line. Fortinet has moved above the 200-day line as well. So you're seeing some of these try to recover. And I guess we'll see what happens today after Palo Alto Networks comes out with earnings. So, anyways, Dr. K, you got anything to add?
No, I think we're good over here. I think it's just you know, let's continue to be diligent on you know, on this market, which can move on a dime. And you know, these fireworks that we saw starting last August, it'll be. I think we're gonna. It might be a binary situation where we get you know, another serious correction of sorts, or right now my gut's saying that right now I think at worst we might see a broken leg type of market where it's trying to make new highs.
Yeah,
and there's,
I think
you know, opportunity in that you know, even on especially on a short-term basis.
Yeah, and so my approach is pretty simple. Focus on the setups. Don't have a bias one way or the other, and just go with the setups and be prepared to go long or short. And I think what will happen is if you are paying attention to the setups, you will naturally be drawn more to the long side at the right time, and then more towards the short side at the right time if the market starts to roll over. So I think that's a reasonable way to operate. If you're a long-only type of person, then you take your shots on the long side and know where your out points are and hang and see how things pan out. But at the same time, be cognizant of 10, 15, 20% gains when you have them, and the fact that you might want to put those in the bank. So pretty straightforward, I think, and there have been plenty of setups that have worked and that we've talked about over the last few days. I think NVIDIA is probably the star of all of them, and if you just catch that, you're doing okay. So anyways, that's all we've got. You guys, thanks for showing up. Have a great weekend, and we'll catch you next week.
So long, everyone.